silver has quietly become a new geopolitical battleground between two superpowers. Let's break it down what's happening, how US and China are responding, and what it could mean next. So, what's happening in the silver market? So, three things are happening at the same time. Number one, silver prices have risen sharply. Number two, China has tightened control over silver exports. And number three, US has tightened trading conditions via margin hikes. That combination is rare and historically very important. Let us deep dive into silver price increase. So, how much has silver gone up actually? So, just to give you a sense, silver price was around $24 per ounce at the beginning of 2025. And by December 2025, it has reached around $79 per ounce. That's more than three times. Now, compare that to the previous decades. From 2013 to 2024, silver mostly ranged between $15 to $25 per ounce. For almost 10 years, silver delivered very little real return. So, this move stands out. How often does silver move like this? So, if you look historically, in the last 100 years, this has happened only three times. First, during 1934 to 1936, when US remonetized silver during the Great Depression through Silver Purchase Act, doubling silver prices within 2 years. Then again, in 1980, where inflation plus Hunt Brothers speculations spiked the silver prices from $6 to $50 per ounce, and then it crashed over 80%. And lastly, the third time in 2011, post financial crisis, due to money printing, silver rose from $18 per ounce to $49 per ounce. Then it fell sharply by 50% within months. So, historically, sharp silver rallies are rare, but they are violent. They go up quickly and crash quickly. Before we get into how China and US are at odds, why is silver even important? So traditionally in early 2000s, silver was mostly used in photography and electronic and solar usage was just about getting started. But in future, EVs, solar panels, green energy storage, and electronics driven by smartphones, AI infrastructure is going to drive enormous demand. Just to give you a sense, in 2025, the total silver demand was around 1.24 billion ounces, against the supply was just 1.01 billion ounces, creating a large gap over 230 million ounces, a trend that is expected to continue in 2026 and in future. Therefore, controlling silver is important. That is exactly what China is trying to do. So, how is China responding? So before that, we should understand that China controls roughly 60 to 70% of global silver supply. It is due to its dominance in refining and processing. They are not the leading player in mining, but because they control refining and processing, they control roughly 60 to 7% of global silver supply. So what are they doing exactly? So they are implementing something called as export controls. So this is not a ban on silver exports, but what they have done is they have reclassified silver under dual use item. What it means is now silver is considered to be used not only for civilian use but also for strategic, industrial, and security use. What it means in practice? It means exporters need licenses. They must disclose end users and end use, and this creates a delay in uncertainty. This reduces exports at the margin, especially spot shipments. And what it means for prices is essentially by limiting physical silver global supply, silver prices will increase. So basically, China is responding by squeezing the physical supply of silver. But US response is slightly difficult. They are essentially responding by financial response. So they are doing something called as margin increases at COMEX. The US silver price is primarily discovered on COMEX, which is a part of Chicago Mercantile Exchange. COMEX is a futures market, not a physical exchange. Unlike Shanghai Gold Exchange, where contracts are settled in physical silver, at COMEX, most of the contracts never result in physical delivery. Paper silver volumes are many multiples to physical supply. For example, for 1 ounce of silver, there could be somewhere between 50 to 250 paper claims. Now, when volatility rises, CME, which is Chicago Mercantile Exchange, they raise margin requirements. Therefore, traders must post more cash, and leveraged longs are forced to sell. This pushes silver prices down. So, has this happened before? Yes, twice. In 1980, margins were raised 5 times in 9 days, and in 2011, margins were raised 5 times in 8 trading days. Each time, there was a violent pricing correction. Officially, this is risk management. In practice, it is deflationary pressure on price. This COMEX versus Shanghai exchange difference, in other words, paper silver versus physical silver market, creates a structural tension. It creates something called as paper versus physical silver arbitrage. Here is the structural tension. US price is driven by paper futures and China price is driven by physical delivery. Since price discovery happens in different manner, prices in both exchanges diverge. If price diverge too much, which is happening right now, when US silver price is around $72 per ounce and in China the silver price is around $76 per ounce. Because of this divergence, arbitrage pressures increases, physical silver inventories get stressed, confidence in paper pricing weakens. The US system works until too many people want real metal and can create a risk of something called as silver run. So in summary, both approaches are totally different. China understands that silver is the industry of future and whoever controls silver controls future infrastructure. China wants control. US understands the same, but US cannot control the physical silver. Therefore, their response is mainly through financial tools. Now, what might happen in 2026? So, I believe in 2026, US might continue raising the margins, which will put downward pressure on silver prices, and China might continue pressure on silver by squeezing the physical supply, which will drive silver prices upwards. There are a few other factors in play. For example, many analysts believe the silver prices will go up because something called as gold to silver ratio. In a long term, that ratio is around 60 to 65, and recently the gold to silver price ratio is around 80. So historically, higher ratios imply silver undervaluation, which means that silver prices, at least in the short term, can go up. Now, what it means for retail investors like you and I. So it is not an investment advice, but historically, silver spikes before retail investors arrive. By the time silver becomes popular, peaks are often close. So, what it means is this could very well be very late for us to enter into the silver market. So, silver is no longer just a precious metal, it's now a financial instrument, an industrial input, and a geopolitical lever. And for the first time in the modern history, the physical and paper worlds are pulling in opposite directions. With two biggest superpowers at odds, who do you think will win this war?